Hello, everybody, and welcome back. Today, my guest is Kathlyn Collins, Head of ESG at Matthews Asia. And today we want to talk about energy, China, and sustainability, three topics that keep financial markets busy. Welcome, Kathlyn.
Thank you for having me.
So the recent energy price hikes shows how fragile international supply chains react to external shocks. So what are the main causes of the current price explosion, Kathlyn?
Sure. So that's a great question. One of the reasons that we are seeing a shock in global energy prices is really due to underinvestment. And so if you look at the spend for exploration in oil and gas last year, it was reduced. And so for the last 4 years running, actually, the level of reserve replacement for hydrocarbons has been reducing. In 2021, the global investment was actually 2 times lower than it was in 2014. And so if you look at some of the forecasts for oil and gas spending, there are forecasts that by 2030, the investment deficit could reach almost 600 billion in oil and gas. And this creates a lot of risk for supply, especially at the same time as the economy comes out of COVID and people are starting to get back out in the economy and do things again. And so the risk of this undersupply has led to higher prices, and that negatively impacts consumers. And the other thing that's interesting to note here is that a lot of these oil and gas exploration projects, they have a higher cost of capital now due to a lot of the focus on ESG. So, there's pressure on governments to continue this green recovery, but at the same time, this is constraining capital going to oil and gas and that traditional energy supply that we're used to.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So the higher energy prices come at a time when China's growth is weakening. So how much growth will higher energy prices cost China in 2022?
This is a bit difficult to predict, right? Because there's a lot of variables here, and obviously the balance is quite dynamic. But at the end of the day, China is going to pay more to oil and natural gas because it depends on these imports. So for oil, it imports about 70%, and then for natural gas, it's about 45%. So some of these higher prices in the input costs will translate to higher output prices, including exports. But at the end of the day, there is some concern in terms of what the higher prices mean for inflation. And on this point, growth and the outlook for growth in China, I want to make 2 other points because it's not just the energy prices that are important. But on COVID, for example, take Omicron or another variant that could pop up. If we were to see something like this result in more lockdowns, that could be very, very significant for global growth and China's growth, because it would have even more repercussions for the global supply chain. And we've only just started to really turn the corner on some of those supply chain issues. The other thing worth highlighting is that higher energy prices will continue to push China to focus on investment in green energy, right? Higher price, so go green. And so this general direction towards the transition to a low carbon economy should continue and be spurred on by higher energy prices.
So this leads automatically to our next question. So China plans to achieve carbon neutrality by 2060. How realistic are these targets in light of recent events and dependency on coal energy?
So this is important because a lot of people question, how realistic these targets are. And I think in order to understand how realistic they are, we need to look at the interim targets because 2060 is a long way out. And so some of the interim targets actually came out of COP26 just last year. So China came out with this new action plan on how to peak its carbon emissions by 2030. And one of the ways that it will do that is cap fossil fuel usage sometime between 2025, 2030. There was one commitment that was a bit more aggressive than the country's prior commitment, and that was to get to 25% non-fossil fuel energy by 2030. Previously, it was 20%. So this is a good interim target that we can look to. Now, in 2020, non-fossil fuel energy was at about 16% of the total energy mix. So low, but that's up from about 7% in 2005. So there's been, a lot of progress there. But the country plans to get to 80% by 2060. So that's a total flop of where we are today. And in order to do that, there's two ways. One, the economy needs to become less reliant on an industry that is less reliant on coal, or the economy just needs to be more services driven. But the focus is going to be on industry itself and decarbonizing heavy industry.
Yeah, this is exactly the point here. So power generation and especially industry account for 70% of emissions. So how exactly are emissions in energy intensive sectors like steel, for example, to be reduced?
Yeah, let's go back to energy intensity for these industries. It's hard to decarbonize them. So China's going to focus on a few things. One, reducing coal-fired power generation that the industries, of course, use, and then also improve the energy efficiency overall as the economy continues to grow. So we know that China is targeting to peak carbon emissions by 2030. So in the next 5 or so years, the issue is going to be on the power sector. And they're going to gradually slow down the coal-fired power generating activities. They're going to add less capacity, but they're also going to focus on that energy efficiency. So if you look at energy efficiency in China, it's below that of the global average. It's about 150% of the global average. So that basically means that China consumes more energy to get the same level of GDP output. And there's a couple of other levers that the government is going to use to decarbonize. So I want to touch quickly on those. One is around the capacity shifts and capacity restrictions. So for example, last year, we know that there was a power crunch. Some provinces started cutting off electricity to heavy industry. And so heavy industry no longer has this preferential tariff rate for electricity. That the power is actually going to companies that are promoting carbon neutrality. So one of the things that we're seeing is that, for example, aluminium producers, they're starting to move to regions with more renewable energy. So regions that have abundant hydropower resources. And that's crucial to reduce their scope 2 emissions. The other two areas that are important is the ETS. So China launched an emissions trading scheme nationally in 2021. And previously, this was only at a pilot stage in a couple cities, but now it's national. And the first year, it's just going to cover the power sector, but more and more of these heavy industries that we've been talking about are going to be covered, probably starting this year: cement, steel, aluminium. And so this has the potential to cover a lot of China's emissions. But what we're seeing now is the price is very, very low. But if you look back to the EU, when they first announced their ETS, the price was quite low. So China has the opportunity to look to see what the EU did and hopefully use that as an example for the price itself. And taking into consideration market forces, government policy, we should start to see that price rise. Lastly is going to be a focus on decarbonizing and electrifying the power grid, which I can touch more on.
So what measures and incentives is the Chinese government using to achieve the announced carbon dioxide emissions peak before 2030 and to direct the economy in the right direction?
Yeah, so one of the ones is electricity pricing reforms. And we saw this in the power crunches last year. So what happened was there was a shortage of coal supply, and this was due to many things: mine safety incidents, a ban on coal exports, and a huge rise in electricity demand, which created a mismatch between electricity demand and how much power was being supplied. Because the coal price was so high, a lot of these power operators, they were operating at a loss. So when the state said, you need to supply more power, there was no incentive for them to do it. So they were operating at a very low capacity. So what the government did was they changed the pricing mechanism. So now there's an ability for that electricity tariff to fluctuate up to 20%. So there's a bit more incentive for the power generators to actually produce that energy. And so that's one thing. There's also going to be, of course, a big focus on the ETS, and that's going to be a huge incentive because companies that have renewable power generating facilities will be able to have credits. Those that don't, of course, will be forced to purchase those credits. And so the ETS should help in the overall decarbonization efforts.
So investors, of course, may ask where the investment opportunities of this transformation, which technologies, for example, will benefit, which companies will profit from this kind of change that is ongoing there.
Sure. So broadly, we see three different areas. So one is renewable energy, one is electric vehicles and the supply chain that comes with that, and lastly is around grid modernization and upgrades. So on renewables, for example, China for the last, decade has spent almost 2 times more than the US in terms of climate action and has greatly outpaced the US in terms of installed capacity. But it's still not been fast enough. We went over what percentage non-fossil fuel energy represents today. So because it hasn't been fast enough, this is going to continue to represent a huge growth area. The country is, charging ahead on both solar and wind installations, and they're actually targeting 1,200 gigawatts by 2030. So renewables in general still represent a huge opportunity for investors, and this is also because it's cost competitive, right? Especially versus fossil fuel energy, the prices come down quite a bit. The second area that we see opportunity is in electric vehicles. And when you think about electric vehicles, this has been an industry that's been born out of the industrial development and policies set in place by the government to really move China up the chain in terms of value adding technology and innovation. When you think about the emissions from an electric vehicle, of course, versus an internal combustion engine, they're much lower. And China is already one of the fastest and largest markets for EVs. And it has targets for 40% of new energy vehicles, all sales, to be new energy vehicles by 2030. That's huge. 40% of all vehicles sold in 2030 to be electric. And then the last big area of opportunity that we see is, as I mentioned, grid upgrades. So, for example, solar and wind, it depends on the weather. And you need to be able to transmit all of that energy a very long distance. What does that mean? That means you have to some way store the energy as well. So just upgrading the entire system, making sure it moves from a decentralized, organized fashion to a decentralized, organized power grid is going to be very, very important. That means investments in high voltage transmission lines, in energy storage systems, the like. So just in general, energy efficiency upgrades is another huge area for opportunities.
Interesting stuff. So this was Kathlyn Collins from Matthews Asia. Kathlyn, thank you very much for being with us today and sharing your insights.
Thank you for having me.